All right, good afternoon. I hope you are good. We are back again. All right. So in this session, we are going to take a question and then solve together. So I would want you to pay attention and then pay attention and then maybe jot down some points. Yeah. So in the previous video, I did some skirmishes on how to apply some concepts and then make sure that everything is fine, right? So in this session, we will be taking the consolidation question and then we'll see how we go about it. So let me start sharing the screen. All right. So as I said earlier in the previous video, um, for consolidation questions, when it comes to exams, for me, what I would do is that I'll use, let's say, 10 minutes to just read through, right? But I wouldn't start it to. I'll use 10 minutes to read through. Then after using that 10 minutes to read through, I will just go and then tackle any other question that I think I'm okay with, especially restructuring. It's a bit easier. And then I'll come to ratios, right? Then still in mind, I will still be meditating on on the consolidation, right? Then I'll tackle the other one. So I'll make sure that I leave 40 minutes or 45 minutes for this particular question. Then when I'm done with everything, I'm coming straight here. Then, as I said earlier, if you cannot do anything in consolidation, Pampua, just identify the group structure, identify the dates of acquisition and reporting. Once you're able to identify the group structure, the date of acquisition, and then the reporting date, you're almost done, right? Because of this, you can just be consolidating them by adding them line by line. So you open your income statement, consolidated income statement account, and then you just be adding the revenue. You take the parent and the subsidiary, you add it, right? Cost of sales, you take the parent and then the subsidiary, then you add it like that. So even if you can't do anything, Crampono, if you're able to just add them line by line, keke, right? You are always like um you get, let's say, half. At least if it is 30 marks, you can get like 15, right? So we'll be doing the workings at this side. I'll be writing the working. When it comes to the workings, we'll be writing here, but I'll be doing the income statement and then the financial position, right? Assets. Statement of financial position as at 31st December 20. Well, all right. Maybe this video might be long, right? So you can maybe put it on 2x or 1.5x, right? So now let's begin. So as I said earlier, for the income statement, for example, you can just, if you don't get anything, you can just come revenue, right? Then let me so revenue into brackets, right? You come and then you take the parent one, which is victory, 400,000. Then plus you take the subsidiary's phone, happy, 150,000. Come and then put it here. Normally, this is how it is being presented. The parent will be first, subsidiary will be second, and then associate will be third, right? So with just these two, you have two ticks. So you can leave it this way and then come to cost of sales. and then 300,000 and 100,000. So into bracket 300 plus 100. Then you leave it like you don't close the brackets, right? So this is how it goes and it goes and it goes and it goes. So you can just start by doing this. This is when the difference or the time from the acquisition date to the reporting date is 1 year. But if it is less than 1 year, then if it is 9 months, maybe this one is going to be 150,000, right? Times 9/12, right? If it is 9 months, it will be 9/12. If it is 6 months, it is going to be 6/12. So that's how you are going to do everything like that, like that. So we will look more into that. So let me read the question. So Victory PLC has invested in two companies, Happy PLC and Comfort PLC. The separate financial statements of the three entities for 2012 are as follows. Statement of profit or loss and other comprehensive income for the year ended 31st December 2012. This is it. The revenue and all of them. This is it here. Now, this is the statement of financial position as well. This is what we have here. This is what we have here. That's what we have. Now, aside the first part, one of the most important things to also look at is the additional information. So you come to the additional information if only you understand everything. If you think you don't understand everything, you can just go straight and consolidate them by doing that simple one and then get some ticks. But if you really understand the whole concept, you can come to additional information that will help you balance everything perfectly. So now, additional information. The first one is saying that Victory acquired 6,250 shares of Comfort PLC in 2005 at a total cost of what? 12,000 Ghana cedis. This acquisition gives Victory significant influence over Comfort PLC. So if you really want to check whether it is true that Victory will have significant influence over Comfort PLC, you just come to the ordinary shares, right? The ordinary shares, the total shares of what? Comfort. Comfort is the last one. So Victory, Happy, and Comfort. So Comfort is the last one, right? So Comfort have what? 25,000 shares. So 25,000 shares, and then we acquired how many? 6250. So 6250 divided by 25,000 is this times 100. It is 25%. It is more than it is more than 20%, so it will have a significant influence. If it was to be less than 20%, then it will just be like an investment, right? So now they say because of this, it has what? A significant influence over Comfort PLC. At the point of acquisition, Comfort PLC retained earnings had a balance of 4,300. The fair values of Comfort PLC's assets and liabilities approximated their carrying amount. So nothing, like no revaluation and the likes happened there, right? So you see here, they've given you what? The opening retained earnings, right? If it has not been given, then you have to find it out, right? In the previous video, we spoke about it, that it is the closing retained earnings, right? Or the retained earnings as reporting minus the comprehensive income for that particular year, right? So we'll look into that. Now, the second additional information here is saying, so here, no, this means that the relationship between Victory and Comfort is what? Is an associate, parent and associate kind of relationship, right? So we will look into that. And then the second one is saying that on 1st January 2012, Victory PLC acquired 32,000 shares of Happy PLC at a total cost of 29,000, right? So now they acquired what? A 32,000 shares. And here, when we look at Happy's total number of shares, here the amount is 20,000 Ghana cedi, but it is issued at what? 0.5. So if we really want to get the total number of shares here, it is going to be 20,000 divided by 0.5. It is what? 40,000. So the total number of shares for Happy is actually what? 40,000. And then Victory bought what? 32,000 out of it. So if you check the percentage, it's going to be 32,000 divided by 40,000 times 100, which is what? 80%, which means we have control over it because we have the majority of shares. It is more than 50%, right? Since it is more than 50%, we have what? Control. So now, Happy PLC retained earning had a balance. So look at it. The date of acquisition is what? 1st January 2012. Keep it in mind. The date of acquisition is what? 1st January 2012. And then this balance sheet is given to us as what? 31st December 2012. So the difference between the acquisition date and the reporting date is exactly 1 year. So this one, you wouldn't need to prorate anything. You are just going to add them line by line, right? So Happy PLC retained and had a balance of 3,500. The fair values of the assets and liabilities approximated their carrying amount, except a piece of land with a carrying amount of 20,000, which had a fair value of 25, carrying amount of 2,000, which had a fair value of what? 2,500. So meaning that the value of the land has increased by 500, and we have to make sure that we include it in our net assets, right? So with this, you wouldn't calculate for any depreciation because it is land. If it were to be a car or a plant or land and building, then that one you look for depreciation and then subtract it. But since it is only land, land doesn't depreciate, so you wouldn't find any depreciation for land. So this fair valuation adjustment has not yet been reflected in the separate financial statement of Happy PLC. The investment income of Victory PLC relates to dividend received from the investees entity as follows. So Happy has we've had an income from Happy of 800, Comfort 200, and then Victory PLC paid interim dividend of 10,000, right? So now the fourth information here is that in 2012, Happy PLC sold to Victory. Now Happy is the subsidiary, Victory is the parent. Now Happy has sold to Victory, right? So in the consolidation, you would have to reverse this because the sales was made in 2012. If the sales was made before 2012, then you wouldn't reverse it. But because it is within 2012, the year of acquisition, we have to reverse that sales, right? So Happy PLC sold goods to Victory PLC at a markup of 20%, right? So meaning that it sold at a markup of 20%. So we have to look for the profit that was on it. So the cost of the good was what? 10,000. So we just have to find 20% of this 10,000, and then that will be a markup for us. And then they are saying that 1/2, so meaning half of the remaining inventory is available at the year end. So meaning that we would have to what? Take that profit out of it. So since there is what? Profit on the amount that we sold, because some of the goods are still available, we have to take the profit out to make sure that the stock will be at the normal price that it was, like it costed the Happy PLC people, right? So the fifth one here is that Victory PLC undertake annual impairment reviews of goodwill. An impairment loss of 1,500 has been identified in respect of Happy PLC for the year ended. So far, no impairment loss relating to Comfort PLC has been identified. The group has a policy of measuring non-controlling interest as proportionate share of net assets. So because it is proportionate share of net assets, we are not going to give them their share of impairment unless if it were to be valued at NCM fair value. If we were to be valuing the subsidiary or NCI at fair value, then we would have shared the impairment loss between them. But since it is not that way, then the parent is going to take all the impairments, right? So now, first, they are telling us to prepare the consolidated statement of profit or loss and other comprehensive income for the for Victory PLC Group for the year ended, and then prepare the consolidated statement of financial position of Victory PLC as at 31st December 2012. So now, first, we start with what? Group structure. So the workings, we would start with what? Workings one. Start with our group structure. So with this group structure, what we are just going to do here is to identify who the parent and who is the parent, who is the subsidiary, and who is the associate, right? Now, Victory actually bought how many shares? Victory bought 32,000, right? So Victory bought 32,000. So uh, so 32,000 all over 40,000. So I said that because the share was issued at 50 pesos. So the 20,000 we have divided by what? The 50 pesos, which is going to give us a total of what? 40,000. Now with this times 100. Now with this, we are going to get 80% control, and then NCI is going to be 20%, right? Now when we come to, so now with this one, date of acquisition is going to be 1st January 2012. Reporting date is 31st December 2012. Sorry, handwriting in your phone. Writing on the screen is not easy. So this is it. I'm just doing the rough one. I will rewrite it well for you. Now, Victory and Comfort right? So you can just scroll back and then pause and then screenshot the question. So what is happening outside? Patrol. So we bought 6250 shares out of the total number of shares. 25,000 times 100. And then we had 25%. And this was around 2005. Right. So now the correct group structure will now be, this is how it is going to be. We have Happy PLC here. We have Victory here. Right. Now, with this, we have 80% share in Happy, and we have 25% in Victory, right? So this is going to be, hey, is it Victory or Comfort? Comfort. Mm. All right. So now, when we come to the NCI, so here is Victory. So Victory have 80% in Happy and 25%. So when it comes to NCI, here is 20%. And then here is Dash. Then others, yeah, Dash. And then this one will be 75%. So this is how the group structure will look like. Then you just bring in your reporting date and then your uh you just bring in your reporting date and then acquisition date in here. So reporting, and then acquisition date. Or you can just start with the acquisition and then report they are the same. So the reporting is 31st December, right? And then the acquisition is 1st January. So you see, this is how the group structure will look like. But you can just do it from the Happy PLC up to here. So here it's okay to get you your full marks, but to break things down, me because I want text. So I'll just be doing this. You can include all this, right? But it is not by force like that. So now, since you are done with the group structure, the next thing you move to is your net asset of subsidiary, right? So we've been able to know our parent and subsidiary relationship. Now we will need to what? Identify our post-acquisition profits and then move on to the next. So you see, you do it step by step like that. So now, um, to net assets of subsidiary. Right, now the subsidiary I having in question here is Happy. Right. So now we will have this at acquisition, and then at reporting. Right. So now, if normally, if you want to know the net assets, we start with the stated capital, but you can also do it by, you can still go around the other way around by bringing all the assets, the fixed assets or the current assets, and then you subtract the liabilities from it, you still arrive at the same thing, right? So stated capital will come. And at acquisition, the stated capital of this thing was still the same. So it was 20,000, as we are seeing here. Happy's own was 20,000. So 20. Let me bring the city sign. Please don't forget to bring in the city sign. As reporting to, it's the same. Now the next one is the retained earnings. And the retained earnings, in the question, they told us that when they bought this, the retained earnings was at was 3,500 here. 3,500. So that's the same thing we are going to put inside there. But at reporting, we were having a retained earnings of what? 4,500. Now, we had a land revaluation, so revaluation will come. And the thing was that the land was what? 2,000, and then it's now have a fair value of what? 2,500. So meaning there has been an increase of what? 500. We bring the 500 in here. And then in the previous video, I told you that when it comes to revaluation, it will be both at the reporting and then at acquisition. So 500. Now, if like this was to be, if this revaluation was to be on, let's say, PPE, and we have this 500, they would tell us that maybe the PPE have an estimated useful life of, let's say, 5 years. So we would now have to find depreciation on it again. So in it would be like 500, oh, sorry, it would be something like this. 500 divided by 5, because it has a what, 5 years useful life. And then that particular amount will only be placed at the reporting side. So for example, this is going to be, I think 25, right? 10, 500 divided, 100, sorry, not a second. So like the 100 will be here, right? But since this is land where there will not be any depreciation, so nothing will come. Now, the next thing we have to look at is that, remember in the question, it told us that here in 2012, Happy sold goods to Victory PLC at a markup of what? 20%. The goods cost Happy 1,000 cedis, and half is remaining in what? In the inventory. So since half is remaining in the inventory, we have to take that profit on that half out of their distance, because now we are coming together, right? Small go together. This one, we are coming together, right? So we have to what? remove our provision for unrealized profit, which is PURP, PURP, which is going to be the half, which is left. So 1,000 divided by 2, a better half, no, times what? 20%. Because it means what also 20% of markup, right? And then we are going to get a PURP of what? 515%, 100. We have to take that one out. You get it? So now with this, we are done. So here we are going to get 24,000. Here we are going to get 24,900. Now, our PAP, post-acquisition profit, is the net assets at reporting minus the net assets at acquisition. So the net asset at reporting is 24,900 minus the net asset at acquisition is 24,000, which is going to be 9,900. Sorry. With this, we share our PAP. We share it to the parent and subsidiary. So share of PAP will come in. So share of PAP. Parent is having what? 80%. So 80% of the 900. And then that is for parents. And then NCI, share of PAP, is going to be 20% of the PAP. This is going to be 720. This is going to be 180. All right. So you see, with this, you are done with the second workings, right? Then now you move on to the third workings, which is we finding what? Goodwill. So 3, computation of goodwill. So computation of goodwill will be this way. You know that goodwill will actually be computed from what? You bringing in your purchase consideration, you add NCI, and then you less what? Net asset acquisition, and you get your goodwill. If in case there's any impairment, you take the impairment out, and then you get your correct goodwill. So now let's start. So we'll begin with our purchase consideration. So the purchase consideration here is how much did we buy the subsidiary for? We bought the subsidiary for 29,000, right? 29,000. So 29,000. 29,000. And then now we add NCI. Now, the question told us that NCI is what? Is valued as the proportion of the net assets. That's what they told us, the fifth one. It is seat one. The group has a policy of measuring NCI as the proportionate share of net assets. If it is at fair value, you do the fair value. So for fair value, it's either you are going to multiply the shares that is remaining by their share price, or they'll give you the value of NCI fair value, right? With that one, you are still, when you are computing for NCI, you what? You do depreciation. So now NCI at its the proportionate share is going to be 20% times its net asset at acquisition, which is 24,000. And we will have what? 4,800. This is the proportionate share of the net asset at acquisition. Sorry. At acquisition. We had 24,000. So that's the same thing here. Right. Now, when we add it, we are going to get 3. Now, after doing that, we what? We less our what? Net assets at what? Acquisition. So less it is what? 24,000 or 2 workings. 2. Then we are getting then we less impairment. Impairment. In the question, they told us that um an impairment loss of 1,500. So we bring in impairment loss of 4,500. And then we get 8,300 for goodwill. Right. Mm. All right. So after computing the goodwill, the next thing is what? Find the value of what? Of NCI. So fourth workings, NCI. Right. Now, what we are going to do is we are going to just put in the value of NCI and their share of PAP. If NCI was to be valued at fair value, we would have bring their share of impairment here, impairment loss. But since the NCI wasn't valued at fair value, there is not going to be any impairment loss for them, right? So value of NCI, we can put workings 3, which said that or the proportionate share of what? The net assets, right? So workings 3 had what? 48,000, 4,800 for the NCI. And then their share of PAP, which is at what workings 2. We had 180 for them. Or what did we get for them? Here we had 180 for NCI. So that's the same thing here. Right, so it's going to be 4987. There's it for NCI. So simple and straightforward. Now, because we have an associate in this deal, the fifth workings should have been group retained earnings as usual. Alright, this one is going to be what? The investment in associates. So fifth workings, investment in associates. which is also, it's just like the NCI share now. So what we are going to do is we are just going to bring the cost of investment. And then their cost of investment was we bought it for 12,000. Right. It was 12,000. So we bring it here. Then the next one here is what? The share of post-acquisition profits that we had from them. So now, the only thing is going to be we subtracting what? The profits at the reporting date minus the retained earnings at the reporting date minus the retained earnings at when we bought them or when we invested in the associate. So the question told us that when we invested in the associate, the retained earnings balance was what? 4,300, right? So now because from that time up to this, we had what? 9,900. So we just have to what? Find the difference and then now multiply it by our share, 25%, because you have 25% share in it. So 25%. Right. And then we are going to get right now we close everything. And this will be our what? Sharing it, this thing. It is simple. Now the next thing we have to look at is now the group retained earnings. Which is basically the retained earnings of the parent. Now, the group retained earnings, oh, we'll begin with the balance brought forward. Of the parent. So the parent's account, the retained earnings at the end of the period is what? 417,830. Right. So the same thing here. Now, the next thing we are going to do is to bring his share of PAP, where the PAP is the post-acquisition profit, which is what? 720. Now, because NCI wasn't valued at fair value, so we will charge all the impairments to this group retained earnings. So impairment loss this was 1,500. We charge everything, so we are going to less it. Right. Now, the share of profit that we had in the associate. So associate will also come here. So the one that we did up there, workings 5, right, will come here. Right. And then know that if this associate, if there were to be any impairment loss in the associate, we would have taken it out of here. Right? We would have taken it out of here. And if also there were to be any kind of sales between the associates and then the parents, we would have adjusted it here. So if the parents should have sold to the associates, we would have taken the profit, the share of profit. So let's say if the parents sold to the associates and then made a profit of, let's say, 2,000, because the parent is having 25% share, then we have to take that 25% of that 2,000 out of our retained earnings, and then at this investment in associates, right? You have to take both of them out, right? But since there's nothing like a sale to the associates, right? Or the associates also selling to the parent, we are not going to do any adjustment here. Further on, we will solve another question where I think we will be getting all those things in there. I think everything will be fine. So now we add all of them, and then we get 418,450. Right. So we add the balance brought down, the share of PAP, and then we less the impairment loss, and then we what? The share of the associate profit to we add. With this, we are done with the workings. Even though there was some intra-group sales, right? You can bring in here, and then intra-group sales, you are going to bring you debiting the sales and then crediting the cost of sales, right? But it will just waste time. So you can just do it straight from the statement of financial profit or loss account and comprehensive income, right? So we are going to do it there. So now this is the workings that we need for this particular work. So this is the workings, right? This is the workings. So now let's hop into the statement of financial position and profit or loss account, and then do the. So now we come to the statement of profit or loss, right? So we just start with the revenue where we add the two of them. So let me do this with this thing, line by line like that. Right. So now, because there was an intra-group sales between the parent and the subsidiary, right? In 2012, Happy PLC sold goods to Victory PLC at a markup of what? 20%. And the cost of the goods was what? 1,000. Right? So what are we going to do? We are just going to get the actual sales value and then subtract it here. Since they sold it at what? 1,000, and then the markup was what? 20%. All we need to do is what? 120% times 1,000, 1,200. So we are going to subtract it here. So minus 1,200. Now we can close the brackets for the revenue. And then this is going to be equal to 400 plus 150 minus 12,200. And this is it here. Now, our cost of sales as well, since we've subtracted the sales from our cost of sales, we have to, from our revenue, you have to also take it out of our cost of sales. So this same 1,200 will be taken out here. So minus 1,200. And then it is going to be equal to plus So now we subtract. So this is going to be our what? Gross profit. Now, because we made an adjustment here, right? For we made an adjustment here, the provision for unrealized profits, right? So that unrealized profits would be that 10%, if that 100 has been added to our inventory already, right? So we have to take it out of the cost of sales because the closing inventory is part of the cost of sales. So here, okay, we have to add it to it. So plus 100, sorry, plus 100. All right. So now this will be our gross profit. Now we move on to our operating expenses. If we should have had any depreciation, like the land that was revalued upwards, if it were to be PPE, like the depreciation will be taken out of the cost of sales, right? But since there wasn't any depreciation, we move in cool like this. And we come to our what? Operating expenses. All right. So the operating expense will also be the consolidation of the both of them. So now operating expenses here. And mind you, we are adding this straight away because the difference or from the acquisition date to the reporting date is exactly 1 year. If it was to be less than a year, we would have apportioned the values for the subsidiary. If it is 6 months, we apportion it on the 6 month basis. If it is 3 month, 3 month basis. So you have to keep all this in mind. So um, operating expenses is now um, 60 plus 47. So 60,000 plus 47,000 equal to 60 plus 47, right? Now we can take it out straight from here, or you can choose to include the impairment loss also in the operating expenses, right? But I mean, sometimes they are per six. So I'll do it this way and then subtract it here. So equal to this minus this, right? Then, all right, then I'll bring in the impairment loss. One five zero zero. Right. The impairment loss, that was if the thing was this thing and kindness, so I say, so we subtract it here. Equal to this minus this. Right. And this is the profit before tax. Right. Then We bring in our taxation. So taxation will come in here. Remember the investment income, we've already treated them because they were broken down for us in the they were broken down for us in the additional information, right? So they told us that happy is 800 and then this thing is 200. So we will take them out of their net profit for the period. Don't worry. So now the net profit before tax, then we bring in our taxation. Now the taxation here is going to be equal to 41,000 into brackets 41,000 plus 300, 3,000, sorry. Hey, no, the taxation is 13,000 plus 1,000 is equal to now when we subtract, we get what net profit after tax. So it's going to be equal to this minus this. Now we bring in our share of associate profits, right? So share of associate profit. So the share of the associate profit is just going to be the associate, their profit, how much we have in it. So remember that we only have 25% in there. So 25% times the associate, this is the profit they made for the period, right? So, and this is because the whole of 2012, we were with them. If we had bought this associate within the year, we would have apportioned it. Maybe if it's 6 months and so we will apportion it accordingly like that, right? So equal to 0.25 times 30. And this is their share of the profit we have. So now when we add it, it is it is simple, just like our normal trading profit and loss account now, but just some kululu things. So you could have gotten 1, 2, 3, 4 without the workings. So 1, 2, 3, 4, 5, 6, 7, 8, and then and I think at least we 8 biwaha, right? So profit for the period is the profit for the period. So this profit for the period, we are going to break it into two, right? So now it is going to be the part that is attributable to the NCI and the part that is what attributable to the members of Victory. So now the profit attributable profit for NCI is just going to be what they have in their comprehensive income, right? 2,000 minus because they sold to us and then some of the goods are still in the distance, and then we've realized a markup on it, right? So we have to take that PURP out, the PEP out, profit, provision for unrealized profit. We have to take it out, right? And then multiply it by 20% because they have only 20% share in this profit, right? So it is going to be equal to 0.2 times 1,900. We have 380. Now, the difference between the 28275 and then this is going to be profit for the members of profit for victory members. Right, so still the total is going to be the same. Then we are done. Rate the statement of comprehensive statement of consolidated income statement and other comprehensive income. Right, so this is it. This is it. Now the next one here, we are going to the consolidated statement of financial position. Right. But this one is also similar to what we just did. Where the income statement, if something was bought halfway, you would have apportioned it like 9/12 and the likes. When it comes to the consolidated statement of financial position, you wouldn't apportion anything, right? So let's roll. Now we start with our normal destiny, which is the non-current assets. We have PPE, right? So the PPE, we are going to just add the two. We have PPE to be 610 and then 2,500. So 610 plus 2,500 by only the parent and the subsidiary associates in count. Then remember that we valued land upwards by 500. We have to increase it here as well. So you see, say without even doing any workings, you can get at least two ticks. This and this is just addition of this and this. Now is the workings, this we have account. Now our next thing here is goodwill. Now let's first deal with investments in associates. So investments in associates will come in here. And that is our workings. Was it 5? Yeah, workings 5. Right, so workings 5 will come. And what did we get for workings 5? Investments in associates. We had 13400. So 13400. Now we bring in our goodwill. goodwill, we had goodwill of 8300, right? That was the workings we had in 8300. So that's workings 3. Now we are done with assets, a non-current assets. So let's just add them equal to so now current assets. Current assets, we will be having inventory. Inventories, we'll just be adding them. So inventories, we are just going to add the 1880. So 188,000 plus the 9,000. Right. So when we add them, and then we did some adjustments up there where we said that because the uh, subsidiary sold to the parent on a profit, right? We have to take that particular profit out of the inventory, remember? So we take it out of the inventory here as well, minus the profit was what, 100. We take it out here. So it is going to be equal to 188 plus 9 minus 100. Now we move on to trade and other receivables. So the trade and other receivables is going to be this plus this. So equals 130,000 plus 21, right? So if in the books of the parent, the associate was owing him, and then in the books of the associate as well, they are owing the parent, we have to take that particular receivable out of this trade receivable. So if the associate was owing, if the, let's say the parent was owing the associate 2,000, then we will bring minus 2,000 here. If the associate was owing, if the associate was owing the parent 5,000, we take that one out here. But since there's nothing like that, leave it like this. Sorry. Bring from here. Now we have what? Cash and cash equivalent. Remember that if there is any cash in transit, you add it to the cash and cash equivalent that you have already. So here come on forward number. So this is going to be 130,000 plus 21. So cash and cash equivalent is going to be 6,000 plus 1,500 plus 1,500. If there were to be any cash in transit, you add it to the cash and cash equivalent. So this one is going to be equal to 600, 6,000, sorry, plus 1,500, which is this. Now, think That's all here. All right. So equal to sum. All right. So now the total assets is going to equal to this plus this. So with this, even if you didn't do any workings, you get 1, 2, and then you get 3, 4, you get 5, 6, you get 7, 8 without doing any workings. Ubenya be correct. Wenya no correct. Wenya no correct. So if say you don't remember anything, just remember that you are consolidating. Oh, kakabum. You are making them look as if they are one. All right. So this is the assets, total assets, and like total assets. Now let's go to equity and liability. Now you see, say what we just did. This thing wasn't having any finance cost. If there wasn't any finance cost, but there was a contingent liability, we would bring the finance cost and here and come and then take it out because the finance cost will what affect our profit. So if we have a liability that we are supposed to pay next year, which is a finance cost, we'll bring it here and then what take it out of our net profit. So net profit before interest and tax. So now we take that one before we bring the tax. But since there's nothing like that, I'll look for a question like that and then we deal with it. Now equity and liability. We bring in our stated capital. Now, if we were to buy the firm with shares, we were to issue shares to buy the subsidiary, then our capital would have increased by the value of the shares. So let's say if it is 2 out of every 5 shares, and then the price of the shares is whatever, you multiply them, then you add the value to the stated capital that you have here, right? But since there's nothing like that, you put in the same thing. Remember, when it comes to equity, we are not consolidating. You only take the parent's equity and then you bring it here. So now equity will come here, the stated capital will come here, 35600 is 6,000. Then we bring in what? Our group retained earnings. And that is workings 6. And what did we get there? Our workings 6, we had our group retained earnings to be 418450. 418450. Now add them. Now we bring in our NCI, which was workings I think 4. Yeah. And we had 4980. We add that one up as well. Which is this. Now, what are we going to do now? We just bring in our liabilities. So trade payables. Right. So now the trade payables coming here. Then the trade payables we have in here is 178,000 and 25,500. So now, if the parent or subsidiary were to be having any payables from any of them, would have taken it out. So if the parent was to be owing the subsidiary 2,000, would have subtracted it from here, right? If the subsidiary was also to be owing the parent 2,000, would have taken it out of here, right? But since there's nothing like that, move on. Right. And then we also have another this thing here called what? Taxation. So we add it. Now we add them. Right. So now we don't balance. Right. So this is it up to this point. If you have any question, you can drop it in the comment section, and then I will be there to assist as well. So this is it here, and this is it here as well. So you see, even without doing any working, you can get some 1 or 2 payables. It's free here. Just add them. Taxation is free here. Just add them. Capital and also share what picking on their to work buying. The only thing here is the workings, the group retain earning, the NCI, and some few other stuffs, right? So yeah, I'm sure say I'll look for some other question, and then I think we'll cover some of the other stuffs I've not spoken about in this video. Thank you very much for your time, and then see you some other time. Bye.